Hey everyone, welcome back to Corporate Decoder. Today, Tempest Therapeutics TPST just filed an 8K, and I'm seeing a significant cash infusion strategy that raises some interesting questions on dilution. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing details a warrant exercise that brings in cash, but also introduces new warrants, which could mean more shares down the road. Alright, let's dive into what Tempest Therapeutics TPST announced on May 28, 2026. Essentially, they've made a deal with some existing warrant holders. Think of warrants like options to buy stock in the future, but these ones were issued back in November 2025. Now, Tempest is offering these holders a deal. Exercise your old warrants early, and in return, you get a new warrant. This is what they're calling an inducement letter. The holders are agreeing to exercise their old warrants to buy about 1.17 million shares of Tempest common stock. They're getting a discount on the price, paying $1.73 per S-share instead of the original $3.5. That brings in some immediate cash for the company, but here is the kicker. For this exercise, Tempest is giving them a brand new warrant. This new warrant, let's call it the new warrant, gives the holder the right to buy up to 2.34 million shares of common stock. So for every share they exercised old warrants for, they get 2 new warrants. The exercise price for these new warrants is also $1.73 per S-share. This new warrant becomes available once Tempest gets approval from the Nasdaq stock market, which they expect to happen soon. It is set to expire on May 28, 2028, giving them about 2 years to use it. They've also agreed to file paperwork to allow these new shares to be traded publicly within about a month and a half. How much cash are we talking about from exercising those old warrants? It is about $2 million. This is before fees, of course. This cash infusion is pretty important for a company like Tempest, which operates in the biotech space and often needs capital for research and development. Now, Tempest didn't do this alone. They had H.C. Wainwright & Company LLC acting as their placement agent, which is basically an investment bank that helps sell these kinds of securities. For their help, Tempest is also issuing warrants to the placement agent, or its designees. These are called placement agent warrants. These are similar to the new warrants, but with a slightly higher exercise price of $2.1625 per S-share. On top of that, there is a fee structure. If the new warrants are exercised, Tempest will pay the placement agent a cash fee of 7%, and also give them more warrants up to 7% of the shares exercised. This really incentivizes the placement agent to get these warrants exercised as well. Now, why are these new warrants unregistered? The filing mentions they are being sold under Section 4, A2 of the Securities Act of 1933. This is a general exemption from registration for certain private offerings. The buyer here has confirmed they are an accredited investor, meaning they meet certain income or net worth requirements. This normally means these securities can't be resolved easily without registration or another exemption. This whole deal around the warrants fits under item 3.02 of the 8K, which covers the unregistered sales of equity securities. Basically, the company is issuing these warrants without going through the full registration process, relying on exemptions that are common in these types of private financings. Looking at the exhibits, we can see the actual documents that lay out the terms of this deal. Exhibit 10.1 is the letter agreement for the warrant exercise and inducement offer. Exhibits 10.2 and 10.3 are the forms for the new warrants and the placement agent warrants. These are the documents that contain all the nitty-gritty details and legal protections for both sides. One thing that immediately jumps out here is the potential for significant dilution. Tempest is bringing in about $2 million now, which is great for immediate needs. However, they are issuing new warrants that, if fully exercised, could potentially double the number of shares outstanding related to this transaction. This strategy is a common way for companies, especially those in the biotech or early stage tech sectors, to raise capital when traditional routes might be difficult or too expensive. It is a double-edged sword. It provides much needed funds, but also dilutes existing shareholders. It is similar to how many companies, particularly those struggling for cash, have used warrant exercises and private placements. For instance, while not directly comparable, many micro-cap companies seeking cash often resort to these methods, and historically roughly half of micro-cap reverse splits, which are sometimes used in conjunction with these types of financings, end in eventual delisting. A 2.3 million share issuance on a base of around 14 million shares outstanding, based on recent market cap and price, is a substantial increase. What I am watching closely here is the company's strategy for using this capital and whether they can achieve the milestones needed to justify the increased share count. The risk is that if development timelines slip or successes aren't realized, the market may not absorb the potential dilution well, putting further downward pressure on the stock. The upside is that if their drug candidates progress successfully, The capital raised will have been crucial for reaching those positive outcomes. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.